Welcome back to another deep dive. Today, we're doing something a little different. I want you to mentally check the calendar. In the world of our source material, it is January 2026.
The very near future.
Right. And if you think back over the last few years, the headlines have been absolutely screaming about AI. AI writing poetry, AI generating movies.
AI taking the bar exam.
Exactly. It's been this massive cultural obsession. But while we were all staring at ChatGPT and Midjourney, wondering if robots were going to take our creative jobs, something huge has been brewing in, well, the one place we didn't really expect, our wallets.
It's a classic misdirection, isn't it? We were all looking at the art, and the revolution just went straight for the money.
It did. Today, we are tearing into a really dense, fascinating document. It's titled The iFinoid Investor Overview and Strategic Investment Thesis, written by a Dr. S. Golkar and a Dr. P. Amidi, and it's dated January 2026.
And just to set the stage for everyone, this is not another pitch deck for, a budgeting app or a new rewards credit card.
No, it is not. It's a proposal for what they call a financial operating system. And honestly, when I first read that phrase, I thought, great, another buzzword.
Sure.
But as you get into it, you realize they're pitching AI as a foundational layer for how money moves around the planet.
It's a bold claim. We usually think of AI as a tool, something you use to write an email or edit a photo. iFinoid is pitching AI as the infrastructure itself.
Okay, so before we get into the weeds, and I want to try a thought experiment. Imagine a world where you never actually open a banking app. You don't pay bills manually. You don't transfer money to savings. You don't worry about overdraft fees. Instead, you have this digital twin, a piece of software that just handles it.
That is the core promise. But we have to be careful. It's easy to dismiss this as just, auto pay on steroids.
Right.
The thesis here is much more radical. They're not trying to build a better interface for your bank. They are trying to build a whole new category they call AI native finance.
AI native finance. Okay, that's the phrase that stuck out to me. Is this just marketing fluff, or is there actually substance here?
It seems to be the latter. The executive summary breaks it down into a combination of two very specific technologies. First, you have intelligent financial agents. That's the brain.
The brain, okay.
And second, a fiat-backed digital coin. That's the blood. And the idea is to create a closed-loop network where software can negotiate and settle payments instantly without ever touching the traditional banking rails until the very end.
Okay. We are definitely going to dissect that coin part later, because I know as soon as people hear coin, they think crypto scam.
Oh, for sure.
And I want to grow you on that. But let's start with the problem. Why do we need this? I've got Apple Pay, I've got PayPal credit cards. The system works fine for me. Why does iFinoid think the global financial system is broken?
Well, you're right. It works for you buying a latte in a developed economy with high-speed internet. But the document really highlights what they call structural inefficiencies. If you zoom out to the global picture, especially for small and medium enterprises, SMEs, and the underbanked, the current system is, it's actually a disaster.
But disaster how? Give me the specifics.
Okay, think about the rails that money moves on. If you're a small business in, say, Vietnam, and you're trying to import materials from Brazil, you are dealing with massive friction.
You mean high fees?
High fees, yes, but also opacity. You've got the FX spread, that's the hidden fee when you swap currencies. That can eat 3 to 5% of your margin, just like that.
No.
And then there's the speed. You send money via SWIFT, and it just disappears into a black hole for 3 days. You don't know where it is, the supplier doesn't know where it is, and nobody's shipping any goods until it shows up.
It's basically digital mail from the 1990s. You just hit send and pray.
Exactly. And the authors argue this reliance on centralized intermediaries like correspondent banks, clearing houses, it creates a bottleneck. And for the underbanked, it's even worse. These are people who might have a smartphone but no access to a fair bank account. They're stuck with these predatory services just to pay a utility bill.
That brings up a term in the document that I admit I initially rolled my eyes at. Phygital. Phygital.
It sounds like a bad sci-fi villain, I know. Beware the phygital.
It does. But in this context, it actually seemed like a really practical strategy. So break that down for us.
It's a distribution strategy, and honestly, it's one of the smarter parts of the thesis because it's so grounded in reality.
Yeah.
Phygital is just acknowledging that cash isn't going away overnight. You can't just launch a shiny app in a cash-heavy economy and expect people to trust it.
So how does iFinoid bridge that gap then?
They propose a network of physical agents. Think of them like human ATMs who are integrated with the digital platform. A local shopkeeper can take your physical cash and instantly digitize it into your iFinoid wallet. It bridges that physical trust you have in your local community with the digital power of the network.
So they're meeting people where they are instead of demanding everyone suddenly become a digital native.
Precisely. It's about onboarding the cash economy onto these high-speed rails without needing a bank branch on every corner. It solves the last-mile problem of finance.
Okay, so the current system is slow, expensive, and it leaves people out. Let's talk about the solution. The digital twin. When I read Intelligent Financial Agent, I'm picturing a chatbot. Hey Siri, pay my electric bill. But the document is really specific that this isn't a chatbot.
No, and this is a crucial distinction. A chatbot is passive. It waits for you to give a command. Pay this bill, check my balance. This agent is active. It's a digital twin that's paired with you, specifically you, and it acts in your financial interest 24/7.
They use the phrase contextual financial intelligence. That sounds great, but let's make it concrete. What does that actually look like on a Tuesday morning?
Okay, so imagine you get your paycheck. A normal banking app just shows the number go up. Maybe you get a push notification.
Right.
The agent, however, has context. It knows your rent is due in 4 days. It knows you're trying to save for that trip to Japan next year. And it knows you have a balance on a high-interest credit card.
Well, it's looking at the whole board.
Exactly. Instead of waiting for you to move money, it might instantly allocate the rent money to a segregated bucket so you can't accidentally spend it. Then it takes the surplus, pays off that high-interest debt immediately to save you interest charges, and puts the rest into a yield-bearing savings account.
Without me even asking it to.
If you've given it permission, yes. It optimizes your cash flow in real time. It basically treats your personal finances like a well-run corporation.
Okay, that sounds great, but it also sounds terrifying.
Yeah.
I'm handing over the keys to my life savings to an algorithm. What if it hallucinates? What if it bets my mortgage on a meme stock because it saw a trend on Twitter?
The authors definitely anticipated that reaction. The document heavily emphasizes guardrails. These are not large language models that can just make things up. They are policy-bound.
Policy-bound. Okay,
Yeah.
That sounds like jargon. Translate that for me.
It just means they operate under explicit, hard-coded constraints set by you, the user. You set the risk tolerance. You say, never touch the rent money, or never invest in crypto. The AI is the interface and the optimizer, but the rules are deterministic. It's assistive, not autonomous in a rogue sense.
So it's less like a gambler and more like a very, very strict accountant.
Exactly. Think of it this way. Right now, you are the CEO and the CFO of your household. You have to make the money, and you have to manage the money. iFinoid wants you to remain the CEO. You set the vision and the rules, but hire the agent as your CFO to handle the daily operations.
I like that analogy. It shifts the cognitive burden. I don't have to remember to move the money. I just have to set the strategy.
And from an investment standpoint, remember, this is a pitch to investors. That creates a massive moat.
The switching costs.
Right. If you have an agent that has learned your spending habits for 2 years, knows exactly how you like to handle your cash flow, and anticipates your needs, are you really going to switch to a competitor just to get a slightly better interest rate?
No way. It'd be like firing an employee who knows everything and hiring a rookie. I'd have to train them all over again.
And that stickiness is gold for investors. It turns a commodity service banking into a personalized relationship.
Okay, so we have the brain, the agent. Now we have to talk about the blood, the iFinoid coin. I have to be honest, whenever I see the word coin in a pitch deck, I get really nervous. Is this just another stable coin trying to print money out of thin air? Are we looking at the next Terra Luna here?
So if you look at the What iFinoid Is Not section, they are incredibly aggressive about distancing themselves from crypto speculation. They state it clearly. This is not an investment vehicle. You don't buy iFinoid coin hoping it goes to the moon.
Okay, so how does it work technically? If it's not for getting rich, what is it for?
It's a fiat-backed digital settlement asset. And the mechanism is, frankly, boring, which in finance is a very good thing.
Boring is good. I like boring.
Coins are minted only when fiat currency, real dollars, euros, pounds, is received into their reserve accounts.
This is strictly one-to-one.
Strictly, there is segregated liquidity, which means for every digital dollar moving on their network, there's a real physical dollar sitting in a bankruptcy remote bank vault. You can redeem it back to cash at par at any time.
But here's the question then. If it's just backed by dollars, why do they need the coin at all? Why not just move the dollars?
Because moving actual dollars between banks is incredibly inefficient. It relies on those old rails we talked about, SWIFT, ACH, SEPA. They're slow, They have operating hours, they have fees. By converting the dollar into a digital token on their own private ledger, they can move it atomically.
Atomic. Define that for us in this context.
In computer science, an atomic transaction means it either happens completely or not at all. There is no pending, there's no processing. When agent A pays agent B, the value transfers in milliseconds. The ledger just updates instantly.
So it's like a private highway next to the traffic-jammed public road of the banking system.
That's a perfect analogy. Once you exchange your cash for the coin, entering the highway, you can drive at 100 miles an hour for virtually zero cost. You only deal with the slow public road when you want to get off and cash out.
That makes sense. It's an internal optimization tool.
Sure.
But this leads us to the biggest concept in the whole document, I think, the agent-to-agent economy. We've talked about me using an agent. We've talked about the coin. But what happens when everyone has an agent?
This is the vision. This is what justifies the valuation. The document describes a network where instead of you opening an app to pay a vendor, your agent talks to the vendor's agent directly.
Walk us through a scenario. Let's say I own a small coffee shop.
Okay. You run a shop. You need to order more beans. Right now, think about that process. You might call the supplier, get an invoice, log into your bank, type in all the wire details, send the payment, email them a receipt. It's manual. It's boring.
And annoying. I hate doing that stuff.
Right. So in the agent-to-agent economy, your inventory system just tells your agent, we're low on beans. Your agent pings the supplier's agent. They negotiate the price based on your preset limits. They verify the funds instantly. The payment is settled in iFinoid coin in milliseconds. The supplier's agent instantly sees the money and triggers the shipping order.
And I didn't do anything.
You got a notification that said, beans ordered, paid $500.
That sounds convenient, but is it revolutionary?
The revolution isn't just the speed, it's the elimination of reconciliation. Do you know how much money businesses spend just checking if the numbers match up? Did we get paid? Is this the right invoice? Who is this payment from?
Huge amounts. I mean, entire accounting departments exist just to match row A to row B.
Exactly. In this system, the payment is the data. The money carries the context with it. It creates a distributed financial coordination layer. It just removes the friction of trust between businesses.
It sounds incredible, but let's put our skeptical hats back on. This is an investment thesis. How do they actually make money? If the transfers are cheap or free to get people to use the highway, where's the profit?
So the document outlines a few revenue streams. First, transaction fees. They're low, but they're volume-based. If you become the plumbing for the global economy, even a fraction of a penny on every transaction adds up to billions.
High volume, low margin. The Amazon strategy.
Right. Second, premium agent capabilities. Maybe you want an agent that specializes in complex tax optimization or cross-border trade compliance. You'd pay a subscription for that smarter CFO.
Like buying better software plugins.
Exactly. But the hidden giant here is float income.
Float income. Explain that.
Remember, to mint the coins, users have to deposit real cash. iFinoid holds that cash in reserve. Even if they hold it in super safe, liquid government bonds, that money still earns interest. If they have billions of dollars in customer deposits backing the coins, the interest income alone is massive.
And they get to keep the interest.
That depends on the regulatory framework, but typically in these models, yes. The platform earns the yield on the float in exchange for providing the free payment service.
That is clever. It's basically how insurance companies make their money. They hold your money and earn interest on it until they have to pay it out.
Exactly right.
Okay, so the business model holds water if, and it's a big if, they get scale. But what kills this company? What are the big risks?
The authors are surprisingly candid here. The number one risk is regulatory delay.
Governments don't like people messing with money.
Especially not after the crypto crashes of the 2020s. The strategy here is what they call modular licensing. They aren't licenses.
What's the difference?
A bank can lend your money out, and EMI just holds it and moves it. It's a safer license, generally easier to get, but it's still rigorous. They plan on starting in EMI-friendly jurisdictions like the UK and the EU to prove the model before they tackle the harder markets.
And what about privacy? If this agent knows everything about my finances, my income, my debt, my bad habits, who owns that data?
The thesis claims the user owns the data and the agent runs locally or in a private cloud container. But that is a massive trust hurdle. Asking people to trust an AI with their privacy is hard enough. Asking them to trust it with their money is? That's another level entirely.
And liquidity. I mean, we saw bank runs destroy Silicon Valley Bank in a matter of hours. If everyone wants to cash out their iFinoid coins for dollars at the same time, can they?
And that is why the full reserve backing is non-negotiable. If they actually hold 100% of the cash, a bank run isn't a crisis. It's just a redemption event. They can pay everyone out because the money is actually there. It's not being lent out to a real estate developer somewhere.
That's a critical distinction. So if we look at the big picture here, how should we view this? Is iFinoid a tech company or a finance company?
The expert verdict, or at least the verdict the authors want investors to reach, is that iFinoid is an infrastructure play. They don't want to be the next bank. They want to be the roads that the banks will have to drive on. They believe that in the future, finance won't be about humans tapping on screens. It'll be about software coordinating with software.
It's a compelling vision. We've covered the three pillars: the agent, which is the brain, the coin, the blood, and the network, which is the body. It connects the dots between the AI revolution and the fintech revolution in a way that actually feels useful, not just flashy.
It moves AI from generation, making text or images, to action, actually doing things in the real world. And that's a really significant leap.
I want to leave you with a thought as we close out. We've talked about the efficiency of this agent-to-agent economy. It sounds great having our software handle the drudgery of negotiating and paying. But if we outsource the act of transacting, the act of choosing, of haggling, of valuing things, do we lose something human?
That's the real question, isn't it? When the friction disappears, does some of the agency disappear too?
Are we ready to be merely the shareholders of our own lives, collecting the dividends while the algorithms run the day-to-day? Or is the struggle of managing our resources part of what makes us competent human beings?
Something to think about the next time you tap your card and wait for the beep.
Thanks for listening to The Deep Dive. We'll see you next time.